Today we'll be covering Chapter 13, which includes a discussion of accounting for overhead cost. After this discussion, we should be able to compute budgeted factory overhead rates and apply factory overhead to production, to determine and use appropriate cost allocation basis for overhead application to products and services, to use normalized variable and fixed overhead application rates and explain the disposition of overhead variances. We should also be able to compare variable and absorption costing systems, to construct an income statement using the variable costing approach, as well as an income statement using the absorption costing approach. And we should be able to distinguish between product costing and planning and control purposes in accounting for variable and fixed cost. We should compute the production volume variance and show how it would appear in the income statement. And we should be able to reconcile variable and absorption costing operating income and explain why a company might prefer to use a variable costing approach. So years ago, direct materials and direct labor were the largest costs for most companies. Today, automated companies such as Dell have lower direct labor costs but much larger overhead costs. Thus, methods for assigning overhead costs to products are an important part of accurately measuring product cost. And you may recall we talked about this idea of overhead cost in a previous session where we talked about overhead pools and creating pools that are then allocated out to cost objectives based on some overhead base, and that the base should have some causal relationship with the pool. And so we're just kind of extending that discussion a little with Chapter 13. And so the following steps summarize how to account for factory overhead. We need to select one or more cost allocation bases for applying overhead costs to products or services. We talked about this earlier, but in this chapter we will use the terms apply instead of allocate when assigning overhead costs to a product or service. However, the concept is essentially the same, determining the amount of each cost pool to assign to each cost objective. Examples of cost allocation basis you may recall could include direct labor hours, direct labor costs, machine hours, or production setups. The cost allocation base should be a measure of the amount of overhead resources, a cost or group of costs such as machinery costs, setup costs, or energy costs used by each product. And so there again we get back to this. There should be this causal relationship between the allocation base and the overhead pool. The cost allocation basis should be the most plausible and reliable measures available of the cause and effect relationships between overhead costs and production volume. Secondly, then, we prepare a factory overhead budget for a planning period, ordinarily a year. The two key items are budgeted overhead and budgeted volume of the cost allocation base. There will be a set of budgeted overhead costs and an associated budgeted cost allocation base level for each overhead cost pool. In businesses with simple production systems, there may be just one set. We then compute the budgeted factory overhead rates by dividing the budgeted total overhead for each cost pool by the budgeted cost allocation base level. Then we obtain actual cost allocation base data, such as actual direct labor hours or machine hours used for each product. We apply the budgeted overhead to the products or services by multiplying the budgeted rates developed in Step 3 times the actual cost allocation data from Step 6. At the end of the year, we account for any differences between the amount of actual or overhead actually incurred and overhead applied to products. Note that the overhead rates are budgeted, they are estimates. Accountants at Enriquez then use these budgeted rates to apply overhead based on actual events. Enriquez selected a single cost allocation base in each department, machine hours in machining, and direct labor costs in assembly for applying overhead. As Enriquez works on a product, it applies the factory overhead to the product using a budgeted overhead rate computed as follows. Budgeted overhead application rate equals the total budgeted factory overhead divided by the total budgeted amount of cost driver. And this is an example that's walked through in the text. So here we see in year 20XO two departments, machining and assembling. And we see that budgeted manufacturing overhead is budgeted at $277,800 for machining and $103,200 for assembly. We see budgeted machine hours for machining at $69,450. And so if we skip the next line and drop down, we see a budgeted overhead rate per machine hour of $277,800 divided by this budgeted machine hours of $69,450, which gives us a budgeted overhead rate per machine hour of $4. And so for every actual machine hour that is incurred or that happens during the year, we apply a $4 budgeted manufacturing overhead. Same is true with assembly. Assembly is spread based on budgeted direct labor cost. And so we have assembly manufacturing overhead of $103,200. That's estimated. We had budgeted or estimated direct labor cost of $206,400 to get a budgeted overhead rate per direct labor hour of 50%, or the $103,200 divided by the $206,400. And so for each, for each assembly direct labor dollar incurred, we apply a 50% manufacturing overhead rate. And so you can see based on these budgets, we developed budgeted application rates for both manufacturing overhead and machine hour overhead. So note that the overhead rates are budgeted. They are estimates. Accountants at Enriquez then use these budgeted rates to apply overhead based on actual events. That is, the total overhead applied to a particular product is the result of multiplying the budgeted overhead rates by the actual machine hours or actual labor costs used by that product. Thus, we would apply $44 of overhead to a product that uses 6 machine hours in machining and incurs direct labor costs of $40 in assembly. And we can see that for machining, we had 6 actual machine hours times $4 budgeted manufacturing overhead per machine hour, and that gets us $24. For assembly, we had $40 of direct labor costs, and our manufacturing overhead for assembly was based on a budgeted rate of 50%. So we have $20 of assembling manufacturing overhead. So for this product, we have total overhead of the sum of those two, or $44. So suppose at the end of the year, Enriquez had used 70,000 machine hours in machining and incurred $190,000 of direct labor costs in assembly. It would have applied a total of $375,000 to overhead to the products produced. This would be by the calculation that says 70,000 actual machine hours times $4 is $280,000. Assembly is $190,000 in actual direct labor cost times 50%, and so that gets us to $95,000, so that the total factory overhead applied is the machining factory overhead of $280,000 plus the assembly factory overhead applied of $95,000. So the total overhead applied would equal $375,000. So this slide shows us the calculation of the machining overhead. Right, we said machining overhead was applied at $4 per machine hour, and so we had 70,000 actual machine hours, which got us to 280,000. This slide shows us that we incurred $190,000 in direct labor cost, and so based in assembly, and so based on 190,000 hours or dollars, $190,000 of direct labor cost times 50% in assembly manufacturing overhead, which was our budgeted rate, we have $95,000 of assembly machining, and so We get to the sum of that as machining $280,000, assembly $95,000, and total factory overhead is applied of $375,000. The $375,000 is an estimate of Enrique's overhead for the year, and it will become part of the cost of goods sold on Enrique's income statement when the units produced are subsequently sold. And so, as you may recall, we said that no one cost allocation base is appropriate in all situations. The accountant's goal is to find the cost allocation base that best links cause and effect. That's this causal relationship we're always looking for. In the Enrique's machining department, use of the machine causes most overhead costs such as depreciation and repairs. Therefore, machine hours is the most appropriate cost allocation base for allocating overhead costs. Thus, Enrique's must keep track of the machine hours used for each product, creating an added data collection cost. That is, it must accumulate machine hours in addition to direct material costs and direct labor costs for each product. If a department identifies more than one cost allocation base for overhead costs, it should accumulate a separate cost pool for each cost allocation base and put each overhead cost into the appropriate cost pool. In practice, such a system is too costly for many organizations. Instead, these organizations select a few cost allocation bases to serve as a basis for allocating overhead costs. And so, again, there's no one exact right answer or way to do this. It becomes a science and an art. And again, what we want to do is to ensure that we allocate all of the costs that we're going to allocate in a way that gives us a true picture of what our cost is, so that for pricing purposes and for profit calculation purposes, for management performance evaluation purposes, we're able to come up with as fair and accurate a picture of that as possible. So when we talk about normalized overhead rate, we're talking about that normal product costs include an average or normalized chunk of overhead. So why the term normal? Because we use an annual average overhead rate consistently throughout the year for product costing without altering it from day to day and from month to month. The result, normal product costs include an average or normalized chunk of overhead. Hence, in a normal costing system, the cost of the manufactured product is composed of actual direct labor, actual direct material, and normal applied overhead. And so if you recall, in 20XO, Enrique's applied $375,000 of overhead to its product, but actually incurred $392,000 of overhead costs. The difference is a $17,000 variance, which we call underapplied overhead, because the amount applied is less than the amount incurred. The opposite, overapplied overhead, occurs when an amount applied exceeds the amount incurred. So when we have actual overhead costs in excess of what we had budgeted and applied as a result of actual production or actual activity in the base, then we have underapplied overhead because the amount applied is less than the amount incurred, and vice versa if the amount applied exceeds the amount incurred. So here again, the difference is a $17,000 variance, which we will call, in this case, $375,000 was applied to $392,000 was incurred. We end up with a $17,000 variance, which we're calling underapplied overhead because the amount applied is less than the amount incurred. At the end of a given period, the company needs to produce its financial statements, which require production costs based on the actual cost incurred. And so in order to do this, there are actually two methods that we can use to account for this adjustment. In our case, it's the $17,000 adjustment. One is a simple but imprecise approach, which just disposes of the entire amount as a write-off to cost of goods sold. Or secondly, a better and a more complex approach is proration, which means apportioning over or under applied overhead to cost of goods sold, work in process inventory, and finished goods inventory in proportion to the ending balances of each account. So essentially, we either write it all off to cost of goods sold for that year, or We prorate it across inventory accounts, which include cost or inventory and cost of goods sold account, and our inventory account would include work in process inventory and finished goods inventory. And so we can choose either one of those two methods for adjustments, accounting for this over or under applied overhead. So the immediate write-off method regards the $17,000 underapplied overhead as a reduction in current income by adding it to the cost of goods sold. So we were reducing net income by $17,000, or income before taxes by $17,000, if we just simply write off the difference to cost of goods sold. Obviously, if it were over-applied, that is, if our actuals were under what our applieds were, we would be picking up income. By the same logic, we would deduct any over-applied overhead from the cost of goods sold. The reasoning behind this method is that the company has probably sold most of the goods produced during the period, so that prorating part of the variance to inventory accounts would not produce a materially different result. Another justification is that if the extra overhead costs result from inefficiencies in the current period, they do not qualify as part of ending inventory costs because they do not represent assets. Because of its simplicity, the immediate write-off method is most commonly used. And so if the objective is to obtain as accurate an application of actual cost as possible, theoretically we should recompute all of the overhead costs of the individual products using the actual rather than the budgeted rates. This approach is rarely feasible. So proration apportionments over or under applied overhead among work in process, finished goods, and cost of goods sold, because these are the accounts where the applied factory overhead resides at the end of the period. While prorating over or under overhead means to assign it in proportion to the magnitude of applied factory overhead in the ending balances of these accounts, a more practical approach is to prorate it on the basis of the ending balances in each of the three accounts. Assume that the ending balances for Enrique were work in process $155,000, finished goods $32,000, and cost of goods sold $2,480,000, which results in a total of $2,667,000 or $2,667,000. These amounts prorated to inventories are not significant, so proration is probably not cost beneficial here. Right, because the two amounts we're talking about that are being prorated, which is different from the option one, is just $155,000 and $32,000. In actual practice, companies generally prorate overhead variances only when it would materially affect inventory valuations and net income. For simplicity, we will assume for the rest of this chapter that companies immediately write off any over or under applied overhead. In general, the cost of a product or service is the sum of direct cost and allocated cost. As we've seen, overhead application is the most troublesome aspect of product costing. The presence of fixed costs is a major reason for the costing difficulties. Many companies make no distinction between variable and fixed cost behaviors in the design of their accounting system. Some companies, though, do distinguish between variable overhead and fixed overhead for product costing, as well as for control purposes. We compare two major methods of product costing in this section: variable costing and the contribution approach, and absorption costing, the functional full costing or financial reporting approach. They differ in only one major respect. Fixed manufacturing overhead is excluded from the cost of products under variable costing, but it is included in the cost of products under absorption costing. And so a variable costing system charges fixed manufacturing overhead as a period cost that is an immediate expense on the income statement, not as a product cost that is added to inventory and charged against sales as cost of goods sold when the company sells the inventory. Note that the only difference between variable and absorption costing net income is the accounting for fixed manufacturing overhead. Absorption costing is more widely used than variable costing, and we might ask, why is that? Well, it's because variable costing is not allowed for either external reporting or tax purposes. An example of how one company uses variable costing is shown in the Business First box on page 541. Nonetheless, the growing use of the contribution approach in performance measurement and cost analysis has led to increasing use of variable costing for internal reporting purposes. Over half the firms in the United States use variable costing for some internal reporting, and nearly a quarter use it as the primary internal format. So let's look at this case just for illustration. We're talking about basic production data at standard cost for Dell Desk PC division. And we see we have direct material per unit of $200. We have direct labor per unit of $75. We have variable manufacturing overhead applied at $20 to give us standard variable cost per unit of $300. And so the annual budget for fixed manufacturing overhead is $1.5 million. Expected or budgeted production is 15,000 computers per year, and the sales price is $500 per computer. For simplicity, we will assume that the number of computers produced is the single cost allocation base for the $20 computer variable manufacturing overhead. Also, we will assume that annual budgeted fixed selling and administrative expenses are $650,000, and the only variable selling and administrative cost is a sales commission of 5% of dollar sales. So here we see there are no variances from the standard variable manufacturing cost and the actual fixed manufacturing overhead incurred is exactly $1.5 million, and the actual fixed selling and administrative cost is $650,000. The variable costing statement has a familiar contribution approach format. So we're looking at the income statement using variable costing, right? The only new characteristic is the presence of a detailed calculation of cost of goods sold, which is affected by changes in the beginning and inventory balances. In contrast, the income statements in earlier chapters assume that there were no changes in the beginning and ending inventories. We account for the cost of the product by applying all variable manufacturing to the goods produced at a rate of $300 per computer. This means inventories are valued at a standard variable cost. We do not apply any fixed manufacturing costs to products. Instead, we regard them as expenses in the period they are incurred. And so again, for variable costing, when we're using variable costing, we do not apply fixed manufacturing costs to products. They are considered period expenses in the period in which they are incurred and expensed accordingly. So the unit product cost used for computing cost of goods sold is $400, not $300, right? And that's why, because we add fixed manufacturing overhead of $100 to the $300 variable manufacturing cost. The $100 of fixed manufacturing overhead applied to each unit is the fixed overhead rate. We determine that rate by dividing the budgeted fixed overhead of $1.5 million by the expected cost allocation base, which were at this point 15,000 units, which got us to the $100. So we have calculated here a fixed overhead rate. So now we're looking at the income statement using the absorption costing method. This separates the absorption costing method income statement separates costs into the major categories of manufacturing and non-manufacturing. In contrast to the variable costing income statement, which separated costs into the major categories of fixed and variables. In an absorption costing statement, revenue less manufacturing costs, both fixed and variable, is gross profit or gross margin. In a variable costing statement, revenue less all variable costs, which are both manufacturing and non-manufacturing, is the contribution margin. So in variable costing, the contribution margin is what's left over to go toward covering fixed expenses. In absorption costing, the gross margin or gross profit is what's left over to cover selling, general, and administrative expenses. We illustrate this difference by a condensed comparison of 20x1 income statements in thousands of dollars above. The difference in the two types of income statements is evident in a comparison of condensed 20x1 income statements. The difference between income reported under these two methods is entirely due to the treatment of fixed manufacturing costs. And so on a variable costing income statement, costs are separated into the major categories of fixed and variable. Revenue less all variable costs, both manufacturing and non-manufacturing, is the contribution margin. On an absorption costing income statement, costs are separated into the major categories of manufacturing and non-manufacturing. Revenue less manufacturing cost, and that is both fixed and variable, is gross profit or gross margin. Revenue less manufacturing costs, both fixed and variable, is gross profit or gross margin, right? And so the differences between variable and absorption costing formats arise because the two formats treat fixed manufacturing overhead differently. In this and in subsequent sections, we'll explore how to account for manufacturing overhead in an absorption costing system. We do not further examine this issue under variable costing because its treatment of fixed manufacturing overhead is straightforward. We simply deduct the total amount of actual fixed factory overhead on the current period income statement. To stress the basic assumptions behind absorption costing, we will also split manufacturing overhead into variable and fixed components. And so, continuing our example of the desktop PC division, we begin by comparing the manufacturing overhead cost in the flexible budget used for departmental budgeting and control purposes with the manufacturing overhead cost applied to products under the absorption costing method. And so, if we look at this flexible budget for budgeting and control versus cost applied for product costing, we can see that the expected variable overhead costs from the flexible budget are the same as the variable overhead costs applied to the products. However, the graph for applied fixed overhead cost differs from that for the flexible budget, and we can see that in panel to the left and the panel to the right here. And so the difference between applied and budgeted fixed overhead is the production volume variance. We calculate the production volume variance as follows. The production volume variance is equal to applied fixed overhead minus budgeted fixed overhead. And if we break that formula down even further, we can see that applied fixed overhead is actual volume times fixed overhead rate, and the budgeted fixed overhead is the expected volume times the fixed overhead rate, which essentially converts to a production volume variance that equals actual volume minus expected volume times fixed overhead rate. And so a production volume variance arises when the actual production volume achieved does not coincide with the expected volume of production used as a denominator for computing the fixed overhead rate for product costing purposes. So when expected production volume and actual production volume are identical, there is no production volume variance. When actual volume is less than expected volume, the production volume variance is unfavorable because usage of facilities is less than expected and fixed overhead is underapplied. We can quickly explain the difference in variable costing and absorption costing operating income by multiplying the fixed overhead product costing rate by the change in the total units in the beginning and ending inventories. Consider 20x1. The change in inventory was 2,000 units, so the difference in net income would be 2,000 units times $100, which is $200,000. And so finally, remember that it is the relationship between sales and production that determines the difference between variable costing and absorption costing income. Whenever units sold are greater than or less than units produced, variable costing income is greater than or less than absorption costing income. This means that when inventories decrease or increase, variable costing income is greater or less than absorption costing income. And so, again, there's a lot of information being presented here, and the easiest way I find to absorb or to understand this is to go back through the chapter and walk through some of the examples that the author provides us with respect to differences between variable costing and absorption costing. The concepts are not difficult. It's just a matter of getting accustomed to the terminology and to how the to the impact on net income or the impact on the variance is with respect to changes in volume or changes in actual cost. So again, I would go back and read this chapter very closely, and then please don't let this audio substitute for a thorough read, and then address the discussion forums and the learning exercise questions. And thank you very much.